Hello and welcome. You're tuned into the Small and Mid-Cap Show. I'm Hiral Dadia and with me is Harsh Saita. Good morning, Harsh. An interesting day of trade with the vibrant Gujarat kicking in. A lot of announcements that are coming in from there as well. But first, let's quickly take a look at what markets are doing, whether there is some vibrant moves coming in on that front as well. Clearly, if you see in terms of Nifty 50, we've seen a broad range where we've been trading at 21,500 to 21,800 is the range that we've been looking at currently as well. We're seeing cuts of around 0.1% coming in there. Let's quickly pull up the bank Nifty as well and see what's happening on that front. Clearly, you know, it's on the borderline. 47,240 is what we're tracking in terms of bank Nifty. Currently, there you go. It's trying to come up into the positive, but not really successful on that front. The advanced decline ratio in terms of Nifty 50 absolutely in favor of the declines. And if you see in terms of stock-specific action on the back of the life insurance data, you have the entire life insurance pack, which is positive. SBI Life, HDFC Life, LIC, as well as ICICI Prudential. All of these counters are seeing gains in today's session. HCL Tech is the top gainer. Cipla from the pharma pack is seeing some smart moves, and you have Adani Enterprises, which is up almost 1.4%. On the losing end, you're seeing some profit booking that's coming in terms of ONGC, BPCL, as well as HPCL. NTPC is trading under pressure. Eicher Motors, as well as Coal India, which is down almost 1.3% in trade. If you see in terms of bank Nifty components as well, the declines are around 9 versus 3 advances. And overall, you just have ICICI Bank, IndusInd Bank, as well as the HDFC Bank, which are trading with gains. But Bandhan Bank is seeing profit booking today. 2.8% is the kind of cuts we're picking up on that one. PNB, Axis Bank, IDFC First, as well as a Bank of Baroda. These are a few of the names which have been trading under pressure. Overall, Harsh, if you go to see, apart from this, in terms of the broader markets as well, you are seeing a lot of stock-specific action. And, you know, whether buy on dips is going to be the strategy that investors are going to adopt or not is what we need to wait and watch, because clearly a range-bound trade, plus you are seeing consolidation, and that resistance level is becoming absolutely strong from here on.
Well, yes, absolutely. In fact, that's indicative from the advanced decline ratio as well, Hiral. You know, currently it seems you are largely in favor of the declines, and that's what's reflecting there on your screens. But let me quickly also take it to the broader markets and where they're placed. Currently, with regard to broader markets, they are underperforming the Nifty. So you're seeing some bit of pressure where broader markets are concerned, and more pressure than what we're seeing on the Nifty. 1/3% lower on the Nifty small cap, even the Nifty mid cap trading with a cut of around 1/5% or thereabouts. So you're seeing some bit of pressure there. And a little bit more than the benchmark. Let me also quickly take it to the sectoral indices. Hiral, you did speak about the Nifty Bank, but you're seeing large amounts of pressure when it comes to some of the other sectors. Nifty Realty is down roughly 1% plus in trade today. That one's meaningful because after 5 consecutive days of gains, that one's you know, on the losing side of things, one of the top losers in trade. Nifty PSE, PSU Bank, that's okay. We're looking at cuts on the Nifty FMCG as well. With regard to the gainers, the Nifty Media, and I'd like to go into the Nifty Media, see the constituents there, because Z is up 3+% after yesterday's news.
And to interrupt over there, you clearly have news which is coming in that Z has said today that they will continue the conversation till the 20th of January. That was just flashing. That's the news we've picked up from Nikkei as well, Harsh. So that's an interesting move on the back of which we did see the stock see gains of little over 4%. Some cooling off has happened, but apart from that, you have the entire pack which is buzzing, right?
Yes, absolutely. You're looking at the likes of a TV18. If we can have that chart again, yes. You have the likes of a TV18 also buzzing. Dish TV, which was down and out in trade yesterday, again higher, 8% higher in fact. So everything outside of a PVR Inox, Hiral, seems to be doing very well within the Nifty Media pack. So that one's in focus today. The other one is Nifty IT, Hiral. And you're seeing positive on Nifty IT as well. If I have checked correctly, yes, absolutely. So you're seeing green there as well. So outside of Infi and Persistent, across the board, you're seeing green on Nifty IT led by HCL Tech. So that's also another positive. Of course, global cues maybe preempting, Nifty IT rather preempting positive action from the US Fed going forward, and some of that starting to get built in.
Absolutely, and but before that as well, you just have the earnings season, which is right around the corner from tomorrow.
Yes.
So a lot of hopes coming in ahead of the IT ones. But let's quickly cut into a few of the visuals that we are still getting from the vibrant Gujarat summit, which is underway. You already have a lot of content that has come in from there on, but clearly you have industries which are coming out and saying that they will continue to support and build what they've done so far in terms of Gujarat. So these are live visuals that we are picking up with regards to the vibrant Gujarat summit as well. But let's quickly take one company in focus in today's session right now as we speak. You have a Texmaco Rail. Now, clearly, it's a great rail infra push in terms of the Indian markets. The stock is up nearly 3 times in 2023 as well. And if you see in terms of today's session, there is some bit of pressure that's building in. But overall, what's the story expected to look like from here on? Indrajit Mookerjee, ED and Vice Chairman of Texmaco Rail joins us. Indrajit, firstly, good morning and welcome to the show. And clearly, if you see in terms of the kind of capex that is being planned with regards to railway as a sector is immense from the Indian government. Your initial comments as to how are you seeing this play out from the orders that are percolating?
Oh, I think this is phenomenal. And I think this is in line with the National Rail Plan. The market seems to be extremely good because that's what Railway is doing, the catching up plan of procurement of freight cars. So we are no exception. We have a great demand. In fact, our order book runs into almost to 20,000 wagons in that level, and orders are flowing in. So we look a pretty positive, we have a very positive outlook for the coming year.
Right, so Harsh also joining in the conversation. So, you did speak about your order book a little bit. Let me try and break down the value. If I understand correctly, around 9,000 crore is the value of your order book. If I'm not wrong, how is the execution timeline looking like with regard to this order book?
I must tell you that we have ramped up our production, and we have almost ramped up by 200% or 250% at this stage, and we plan to ramp it up further. So, answering your question, the current order book which we have right now can be completed in next maybe 1.5 years, 18 months to 20 months time. But at the same time, the new orders are coming in. As you know, that there's already been pending tenders of another 15,000 wagons and 10,000 of advanced wagons. So all these are already in the market. The closing dates will be very soon. So we think that the flow of order will be continuous, and it would keep us going for many more, at least for a few more years. More than what we have.
Indrajit, overall you mentioned about the kind of revenue visibility that you have from the order book positioning currently. At the end of the second quarter of FY24, the capacity utilization was almost 96%. You are ramping up production as well. Currently, how much is the capacity utilization? And secondly, to what extent is the ramp up expected to look like in the various segments?
You see, the capacity utilization is a bit of a misnomer because we can always increase the capacity out of the same facilities through debottlenecking, and this can go much higher than what normally we look at the capacity utilization. So we, from that angle, we are already doing 3.5 times more than what we had produced, say, about 2 years back. And if you look at the wagon capacity utilization, it's even more than 200%, I can even say. But whereas the capacity utilization of our foundry, which actually feeds the components for the wagon manufacturing, that utilization is running at the level of over 90% plus.
Right, sir. And sir, just to kind of get better context, a slew of orders expected to come in from the Indian Railways. You've picked up a chunk of that. Around 17 odd percent is your market share in the most recent order win, which happened in December, if I understand correctly. So, sir, going forward, would you look to maintain that kind of market share, given the kind of execution capability you have?
I think we can. We are confident about it. There would be more orders coming in from Indian Railway, but we shouldn't forget that the private orders, out of our total order book that we have, about 15 to 18% are the private and the export orders. And even that market is also booming. So combination of that, I feel quite confident that unless something very, very unprecedented things happen, we should be continuing with this momentum.
Okay. Overall, from an export perspective as well, you are one of the players and you've seen 3.5 times growth in export of components and railway castings as well. How much do you think exports will start contributing, with regards to overall business, and what's the growth that you're expecting there?
Well, as far as the exports concerned, firstly, let me tell you that the market is very good. It's good because of geopolitical reasons. The reason number one is that Africa is growing and the market in Africa is very strong. Right now, we have a very huge orders of African order from a very large conglomerate, that's from ArcelorMittal, where we are serving quite a large number of wagons to be delivered to them in Liberia. And similar orders are in the offing. Coming back to Europe, Europe has a shortage of components because supplies from Ukraine have dried up quite a lot. And we have a partner in Europe who is a joint venture partner from Czech Republic. We intend manufacturing wagons in India, and they also require components from because of the Ukraine shortage, and they decided that they would buy from us. So we have some good market. So coming back to the questions of how much percentage, I would say that to start with, about 10% would be of the turnover would be there in the export market, about 8 to 10% in that range, whereas the profitability is going to be much higher because of the better price realization.
Right, sir. And sir, with regard to your revenue split as well, do you expect the mix to change substantially going forward? Will it change in the favor of margin accretive businesses and margin accretive products? How should one look at your margin evolution as well as your revenue mix?
Absolutely correct. Absolutely correct. So we have currently, as far as the wagons are concerned, we are looking at a split between Indian Railway and the private and export. And the private and export, fortunately, give us better margin. So we, of course, we have got certain commitments to Indian Railway market. So in no way I would like to say that we like to neglect the market. We like that market and we like to serve Indian Railway for various reasons. So there is going to be a split between in our turnover between the private export and the Indian Railway. But we also have realized, and we have moved very fast into the component market. So we feel that the railway components is a very good business. To start with the export, I just now explained. There's going to be very strong foundry business. So the casting products from our foundry is going to come out for export market too. We are debottlenecking our foundry capacity. We are going up by something like about 10,000 tons, which is close to 25% of our present capacity. And I would be not doing justice if I don't say that our foundry is the only foundry in the country whose product is approved by the Association of American Railroad, which means that we are free to supply to American market, which is a very difficult task to do. But I'm happy to say that we have been approved by that for quite past few years, and we have been supplying to our partners in the US.
Right, Indrajit. So clearly, you know, the healthy wagon order book that you're talking about and the kind of capex is providing a good revenue visibility as well. And the restructuring of the EPC business, that has been, you know, a move in the right direction for the company. And with the turnaround in financials, because between FY19 to 23, we've seen a revenue growth of around 5%. That's the CAGR growth. But now that turnaround has started to come in, and the fundraise to fund the capex is auguring well. So that's the story with regards to where Texmaco goes. But let's quickly slip into a short break. Once we are back, we'll talk about Elecon Engineering's capex plans and growth strategy from here on. Please stay tuned to NDTV Profit.
Welcome back. You're watching the Small and Mid Cap Show here on NDTV Profit. Thanks for staying tuned. We of course spoke with Texmaco Rail just before the break, but we have another one, Elecon Engineering. That's another company in focus. Company has guided for a consolidated revenue of 2,000 crore rupees for FY24. Expect 1,700 crore in revenue under the gear business, and we're going to try and break down some of the financial performances of the past as well as what to expect from the future. We have with us Kamlesh Shah, who's the Group CFO of Elecon Group, joining us on the show. Welcome on NDTV Profit, sir. Just want to try and get some perspective. I believe there's an audio issue. Can you hear us, sir? It seems we have an audio issue. But while we're at it, let's quickly have a look at some of the names which are buzzing in trade today. You have the likes of KIOCL, which is down roughly 3.5% odd. Production not happening at their plant, which is why that one is down. We have the likes of a Delta Corp, which is down 2.5% on the back of numbers. But we have with us Kamlesh Shah, who's the Group CFO of Elecon. I believe he's back with us. Welcome to NDTV Profit, sir. Just want to try and get perspective. 2,000 crore is the FY24 target. What are we looking at in FY25? And give us the split between gears, MHE. How should one look at some of those numbers going forward?
I think
okay.
we're losing the management, but clearly, what's happened with Elecon in terms of stock performance is also pretty interesting. If you can just quickly pull up a one-year chart of Elecon to see the kind of moves, there you go, almost 7 to 8% is the kind of up move that we've seen, and there has been a consistent rise on this one. Now the guidance is 2,000 crores for FY24, but let's see if they are able to actually overshoot this number as well, taking the performance into consideration. So that's going to be interesting to watch out for. And clearly it's the export business and the gearbox side that is expected to drive growth. That is what was indicated so far. I think we have Mr. Kamlesh Shah, who's back with us. Kamlesh, are you able to hear us?
I can hear you. Yes.
Okay, so Kamlesh, we were talking about your revenue guidance of 2,000 crores for FY24. I'm sure you're on track for that one, but any chance where the company will overshoot that number, taking the performance so far into consideration?
As such, these numbers, we are quite confident and we are towards to achieve better than what we are given the guidance. However, if you refer our earlier guidance of 2,000 crore at the beginning of the year, the steel price was higher. And if we see today, the steel price is lower by 5 to 7%. So if we make the effort and if we may change our formula, so we are doing better than what we are given the guidance for 2,000 crore.
Right, sir. And sir, with regard to FY25, what can one expect? Because we're at the fag end of FY24, last quarter, just 2 months to go now for year end. How should one look at FY25 and how should one look at your revenue mix evolve between MHE and gears? Which is the better margin business? I'm guessing it's the MHE. So how will that gear up? If you can give us that overview.
Now MHE is already on the track. Whatever the earlier projects were there, we already closed. In fact, we have realized the money from the customer also. And over and above, we also have realized our arbitration award, most of our arbitration award. And we have further initiated the arbitration award. So we are having that is better realization going forward for MHE. That is very much sure. And recently we already discussed, by October already we have received the 2 big orders for the supply of equipment only. Which we are focusing on the supply of equipment only as a part of our business strategy. So that definitely will have a better margin going forward for MHE. And we associate the way in with the steel sector is doing well for last 2 years. And going forward, we also are expecting the better revenue growth in the sector of cement as well as the power sector also. And because the mining sector is also booming up well, the material handling equipment requirement will also come up. We see the good traction so far the India story is concerned for the material handling equipment is concerned.
Okay. So Kamlesh, overall from a capacity perspective, you have outlined a capex of almost 70 crores in FY24. How much of it is spent and how much are you expected to spend in FY25 as well, and what will that take your capacity to?
Considering our revenue guidance, what we see that revenue prospect going for in the next 3 years, we already have spelled out our capex of 300 crore last year, of which we already spent 30 and 70 we are going to spend in this year. And we are on track so far. The spending in this year is concerned for 70 crore. And based on the revenue estimations, which we are just now going to finalize anytime, and we are just going to declare our the FY25 guidance for revenue, we will do in that time, we will further spell out what my capex will be there. But so far as the capex of 300 crore over the period of 3 years, we are very much on track. And we are quite positive about the revenue, both in India for us, as well as the opportunities being created for us in the overseas market for our gear division.
Right. You have a 39% market share, very impressive in the gears business domestically. Also, your guidance for exports is roughly 40%. What's the base of exports like currently within your revenue mix? So let's take the revenue at 2,000 crore. What component of that is export? So what's the base that you'll be growing at? You've guided for a 40% growth.
If we see our revenue of consolidated revenue of 2,000 crore, what we are given the guidance, of which our overseas business is nearly 25-27%. And our target is to grow in next 3 years by to reach to the same to 40% level also, considering the growth in India also. And by FY30, we have given the guidance of my revenue mix between the domestic and overseas. Overseas, we mean the overseas business itself plus export from India, which should be 50-50.
Okay. So that's the divide that comes in from a geography perspective. Let's talk about your order book. Currently, where does it stand? How much of it is executable in 24? How much of it will be in 25? And what's the bid pipeline or the order pipeline expected to look like?
If I give them my order book position presently, which is of 738 crore, of which nearly 600 crore is nearly 550 or 600 crore is executable in this year itself. And balance, further revenue, further the order booking will further grow in the coming Q4, and which will stand me to talk about for my next year guidance. But we are very much bullish and we are positive for our overseas business, which are coming the way in which we are expected. Now we are just waiting for the my commercial production to start for the OEM business. We already captured in Q1 and Q2, which is expected to start the commercial production by September 2024. And then I will take a big leap for my overseas business too.
Right. Thank you so much, sir, for that perspective on Elecon. Of course, stock doing very, very well. Thank you for all of that.
Thank you.
It's been a pleasure having you. Also, with that, we're completely out of time on this edition of the Small and Mid Cap Show. From Hiral, myself, and everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More on the other side.